And I'm looking through your notes, and this line jumps out at me, that while the worst looks to be behind us, the bear market journey is not yet complete. Walk us through that call. Why is that the case?
Well, look, we think that the Federal Reserve is not entirely done with tightening monetary policy, trying to restrain U.S. economic growth. They're not going to be satisfied unless the unemployment rate rises more significantly. Now, how that can happen, I think, varies a lot from people's expectations. I think that if you look at our mid-year outlook report at Citi Global Wealth, we've seen investors believe that there's a singular moment in which the entire economy collapses, financial markets collapse, and suddenly all of the risks will be behind them. Instead, we think that there are really rolling recessions that are ongoing in some industries right now, manufacturing, trade, and some components of construction. This is helping get that behind us, in fact, and leading to a period of growth. But I think you will see employment, which has been outperforming the expansion in the economy by far. We're going to have a period in which labor markets actually lag behind the economy. And I think that the Fed will achieve its goals that way. But are we feeling as if there's a period of just a really depressed economic activity and it can bounce back with very rapid growth in the next couple of years? That's unfortunately not the case.
When are we going to start to see that? Because we've been waiting for that labor market weakness to show up for months now, and it kind of has defied expectations. I believe we're 11, 12, 13 months running where economists have trailed the estimate for non-farm payrolls.
Well, it can go on for some time still. And of course, if we just look at the very latest claims data, you would think something is brewing. If you take a look at the layoff announcements, gross layoffs have picked up in a way that's consistent with a mild recession. But if you think about what's happened to a few industries, I think economists have wanted to say, well, this is labor hoarding. But if you look at it industry by industry, there's some reasons to believe that the effects of monetary policy tightening are going to take longer this time rather than shorter cycles where everyone's focused in terms of market expectations moving rapidly. Just take a look at what's happened in the housing industry, traditional cyclical. We've moved up multifamily apartment construction to about 135% of the level of single-family construction. We're going to see the delivery of 1 million new apartment units over the course of the next year. It takes 17 months from groundbreaking to completion on those units versus 7 for single-family homes. And that, by the way, is going to help take down shelter inflation, I think, very sharply in the coming year. But it's longer cycle, greater impact. Then, of course, you just have asynchronous cycles in terms of services. There's no doubt that there's an absolute boom going on in leisure and hospitality, very labor intensive. There's very little automation and innovation going on there to automate that type of output.
Right.
And it doesn't look like a recession at all. It looks like we're in the midst of a pretty good recovery.
So explain how you want to be positioned, because in your note you mentioned that in 2022 you basically look to be defensive, but perhaps now it's time to consider being offensive. What does being offensive right now look like?
Well, it's interesting because our initial take on this has been that some of the defensive trades of 2022 have worked as well as they could. For example, pharmaceuticals. We don't think it's an overvalued industry. These are great long-term defensive income-oriented stocks. They fell 2% last year. And if you think of the S&P down 20, the rate victims in the large cap technology space. Now, you're wondering why they can rally back on some good news so sharply now. Well, they were down very, very hard last year. With some real innovation and with some relief on the inflation and interest rate front, no doubt they're going to climb. So we think that some of the opportunities that are really interesting right now are in some cyclical areas that we've wanted to avoid. If you think about small cap growth stocks, the valuation gap to large cap U.S. growth stocks has opened up to the point where it may be worth taking that risk.
Talk to us a little bit about the cross-asset landscape, though, because you mentioned rates in talking about large-cap technology. And, of course, coming into the year, this was heralded as the year of the bond. When you're looking at, the Treasury market, when you're looking at the credit markets, what's your weighting there?
It's overweight in treasuries, and being 300 to 400 basis points higher than a few years ago, I think is quite rewarding. If you take a look at real interest rates, take a look at TIPS. It's not as if the bond market is incredibly cheap overall, but the value can add to portfolios, to diversify them, to dampen the volatility in riskier parts of the market, whether that's really high risk credit or equity markets. We're at a yield level and a point in the economy where they should have some negative correlation again. And they have. We were driven down in 2022 by a singular factor, the Fed going from incredibly accommodative to restrictive. And lagging behind the inflation of 2021, saying we're going to put a stop to this. And that really knocked down all these asset classes. The impact in the valuation of bonds was worse than in the equity market. So I think if you are using bonds now to manage volatility, to drive some income in portfolios, and to improve your risk-adjusted returns, it's very much a place actually to put fixed income back into portfolios again.
And Stephen, we only have about a minute left with you, but when you're talking about the bond market and the overweight that you have, particularly in the U.S. Treasury market, where on the curve are you talking about?
This is really important because no single bond can provide everyone what they need in a portfolio. So many investors think, well, I just own a 6-month T-bill with the highest yield, that somehow all of my problems are solved. I'll get 2.5% for 6 months and it's all over with. Well, the problem will be is reinvesting. And you won't find the negative correlation, the price appreciation, the hedging property without some longer duration bonds. So, the front end of the bond market has great yield. We're overweight there, but we want to also have some long-term duration yield and weigh that out. And again, to have an average maturity that's kind of intermediate. And what do you do, again, to have that in a portfolio and still have equities? Well, you can avoid the Japanese government bond market and a whole variety of really awful yielding